We will be starting shortly. As usual, we will give it a few minutes for people to join and we will get started. Thank you all for joining us again, and I will be with you shortly. Thank you.
Oh, good evening, everybody. Thank you again for joining us for this ninth week of the FinTech Summer Sessions. We've got this session and one last session to go, and that's going to be it for 2023 FinTech Summer Sessions. So we really hope that you have been enjoying this series, and I'm sure you have because we see a lot of returning participants with us. Thank you so much for coming back. We've gone through several interesting topics throughout the past 8 weeks. We've touched on AI, we've touched on embedded finance, on banking as a service, and many, many other topics throughout the past few weeks. And we're coming close to wrapping things up for this year. And for today's session, we have another very exciting topic with an amazing speaker with us, and I would say someone that has contributed significantly into the entrepreneurial ecosystem in Saudi Arabia. So first of all, on the topic, we're going to be talking about investing today. We're going to be talking about investing with a focus on investment in fintechs as well. So we're going to cover the different stages of investment, how investors look at investment opportunities. And this is an excellent opportunity for all of you who are with us here that are thinking about starting your own fintech, that are thinking about where do I raise money from, how do I raise money, and what are the things that I need to take into consideration. And there's no one better to speak about this than Hussein Al-Attar, who is an active investor in the Saudi ecosystem, has been on all sides of the equation, so has been an entrepreneur himself, but has also gone to the other side and is now an investor. He is the CEO of Tech Investcom. He is also a board member on several companies, has played a role in angel investing. So he's covered the whole spectrum when it comes to investing and working with startups in general and fintechs as well. And without further ado, I think this is going to be one of those sessions that you will enjoy immensely. Please don't forget to put your questions in the Q&A. We will make sure that there is a Q&A session happening towards the end. And with that, I'm going to pass it on to our dear guest and friend, Hussein Al-Attar, to take us through this amazing session. Good afternoon, Hussein. How are you?
I'm great. Thank you, Kareem, for the intro. You actually helped me on a couple of slides that I had already. Let's start. Let's begin. First, yes. So this is the agenda that we're going to go through today. As discussed, we're going to discuss the investment options startups have and why you should raise investments and what advantages that can give your startup. We'll talk about the different startup stages, expectations that you should have from investors, expectations investors will have about you, and also current advices and key players in that stages. Then we'll talk a bit about crowdfunding, venture debt. These are more focused on the startup side and how other options they could raise investments, how to pitch, what are the requirements to prepare, data room, and then general advices. And as Kareem mentioned, I've gone through different parts in my life where I was in corporate, and then I joined the startup life and raised investments and through an accelerator. And then I went to the dark side, joining a venture capital firm, Tech Investcom, and also played big parts into angel investment groups like Falak and Raqal. And I am also a board member of the Venture Capital Private Equity Association that lobbies for the VC sector for government and helps improve the regulation and education of investments into startups in Saudi Arabia. About Tech Investcom, it's an investment firm that started back in 2005 with 1 billion riyals to invest in technology companies. We were investing into private equity. We moved into venture capital, investing into late stage startups like Foodex, Tamara, Merit, Retail, or many of these tech startups that you might have already heard of. But let's start and begin. What are the options for investments? People think, oh, investment is the only way I can grow my company. No, there are other options before you consider raising investments from third-party people. You could do it through revenues. Revenues could be actually from crowdfunding. There are options for crowdfunding without giving equity. We'll mention it later on about how you can help collect different donations and money to help you grow your company. Revenues, helping using your own revenue of the startup to fund yourself and grow by that. And grants and awards, these are usually given through participating in different startup contests that will give you a prize in the end, and you can use that to help fund your startup. The other one is debt. Debt could be utilized by getting a loan from banks. That's a line of credit. There is also something called venture debt. That's we'll talk about later. That's focused only for startups because sometimes getting loans, as you know, from banks is very difficult. They have huge requirements. There are firms that are more supportive for startups, but also will require a much more interest or find different ways to mitigate that risk. And also convertible notes, which we'll discuss later. That has to do with SAFE and KISS notes. These are different ways where startups can get funding without giving equity yet and move that equity transaction until an investment round happens. We'll go into details later. But let's focus on our most important part, investments, which means you're getting money and in return, you're giving part of your company as shares to different investors. These also come in different stages. You start first with your family, friends, people who believe in you, people who understand your strengths, your weaknesses, and believe that in your vision. Then comes angel investors. These are different individuals, whether they were high net worth individual who have a lot of money and they want to invest into companies, or they are actually normal employees or CEOs of companies who have an extra income and want to diversify their investments and decide to give some of that to participate in investing into tech startups. Then come firms like us, venture capital firms. These are firms that started and focused, dedicated to invest into tech startups. They get money from different investors and promise them to invest in a certain criteria, agreeing on investing in which stage, in which sector, which geography, and utilize that money to invest into different tech startups. They usually have a much stricter process. They have a investment committee, they have due diligence that they have to do, and different requirements that they have to maintain so that they can invest into different tech startups. Afterwards, when companies mature beyond the stages of a startup and become more established and are ready maybe for an IPO, private equity firms start to come into the play. They start to invest into companies, taking maybe sometimes a majority, sometimes a minority, and or different structure that they might have. But they help companies improve the governance of these companies and better management of it, so that it's prepared for the public markets. Then you ask yourself, do I need to raise investments? Well, the answer is no, but raising investment from investors gives you some advantages. Number one, it increases your competitive advantage because you're able to utilize that money to hire talents. You can improve your products much faster, and you can spend much more on marketing and sales. Also, as you go through the journey of building your own startup, you'll notice that you don't know everything. And there are things that you think you have planned for, but there are always unknowns and hurdles that come in the way. So having that extra capital to help burn and learn from and be able to reach to product market fit is very useful for any startup to have. And then there's the other part, which is smart money. Investors that add value more than just the money they provide. They help with introductions to customers, they help with governance of the startup, or also with the regulations or connections with their people in different areas. So these are usually the typical things that any startup will get as part of investments from any external investors, especially for fintechs. Many business models, when it comes to fintechs, you need a lot of working capital. And being able to get it from a bank or anywhere else that will supply you with that capital is a bit difficult, especially in the early stages. So having investors join you and give you that working capital to be able to test it out, roll it out with the users, and make sure your product works is very useful. And when you start applying to different licenses, many of them have some capital requirements to get that license. So especially if you're early stages, having those capital requirements of 5 or 10 million reals is a bit difficult. Getting it from investors to help you at least get the license and proceed, it will be very beneficial for you to start and move fast in building your company. So as we mentioned, we'll be talking about the different startup investment stages. We have the pre-seed, that is usually ideation stage, seed level, and then series A and B and C and D and whatever more investment the startup needs until it reaches to maturity. At each stage, I'll be discussing 3 things. Number 1 is what will investors expect from you? Then I'll tell you what you can expect from investors. And lastly, explain who are the key players here and some advices. So at the pre-seed stage, and I just want to mention ahead of time that in the industry, there is no one common agreed terminology for what pre-seed means or what exists or what is expected for startups to be. What I'm mentioning here are what helps you increase the possibility of closing the investment round. AKA, if you have these things, you have a higher probability of closing the round with investors. But it's not a strict rule, and it's not a thing that everyone will agree on depending on the investor you ask. So the requirements: a planned idea or an MVP. MVP is a minimum viable product that showcases that your idea is working in market. A dedicated founder, and this is a questionable maybe thing between different investors, especially when a person who's coming from a corporate background is trying to build something. He is not yet ready to leave his company to build this to build the startup. Do I really need to be dedicated? This is what I'm mentioning, where it depends, because you are trying to showcase to investors that you are serious, that you are willing to risk your livelihood for these companies. That's how much you believe in the startup. So this helps you be able to convince the investor that it is a startup worth risking your money to invest in. And then having evaluated the whole market and growth, making sure you have really looked at all the competitors, everyone who's in the market, what are your customers doing? You have to really know that industry very well, so the investors understand that you understand where you are. What can you expect from investors? Investors at this stage could invest between $50,000 to $150,000. Some of them are with equity, and that means they're going to take equity of you, and some of them without. They're willing to give it to you as grants without any expectation return. These are usually done as part of accelerators who will also add to you some office space, training, consultation, support, things that will help you move from your idea stage or the pre-seed stage to the seed stage where you are ready for investors. The logos you see here on the screen are different accelerators, some run by government, some run by corporations that are willing to invest or give funding or help support startups at this stage to help them move from pre-seed to seed. Also, just to mention some maybe clarification, that there are venture capital firms that are looking to go into early stage companies, especially pre-seed, or become the first check into a company. These are a list of some of them that like to invest very early stages. To some founders who want to start a company, sometimes they lack certain knowledge about the technology side. They have the business sense, they have the sales sense or the marketing sense, but they lack the CTO or the technical expertise. So a new terminology came around, who are venture builders. These are different. These are firms that are willing to build your tech needs for your startup in return to shares in your company. And some of them add more than just the tech side. They might add marketing or human resources or help you build it from the ground up. But different venture builders have different requirements. So it's better to understand each one, what will they offer and what they expect from you in terms of shares. And also, if you're planning to just build something for your own, which you just need to build as an MVP, there is e-commerce enablers that you can use. These are different platforms in Saudi that will help you build up your startup or a way to be able to transact with your users in a very quick and fast way. Some general advices here. This is an optional stage. Not all founders go through this stage. Some of them bypass it, especially founders who have previously built startups and are able to raise a bigger amount and are considered seed stage because they're able to build it and fund themselves from the beginning. So it's not for everyone, but again, it's useful to utilize these different terminologies as pre-seed and seed to manage the expectation of investors of how much you're going to raise and how much they're going to get out of your company. You have to do your competitive analysis and identify your competitive advantage, because the first question you'll get from any investor is who else in the market and how do you compare to them. And missing any competitors puts you on a disadvantage. It shows the investor that he has more knowledge about the market than you. You don't want that to happen. You want to be the most knowledgeable person about that market to be able to convince the investors that you are the right person to run the startup. The other part is choosing the right partner. This is where you're trying to build your company. You are finding the person who is well equipped to build with you. One of the main red flags most VCs agree on: a solo founder is not a proper investment, proper type of investment to go into. Usually, we like to look at startups that have 2 or 3 co-founders at least, because each co-founder will have different complementary skills. Also, because of the risk, when we invest into startups, we invest into the founder, the team itself, and the product and everything that's under it. Having that founder be sick or unavailable for any time puts the startup at risk, which we find as an additional risk to our investment, which is already a risky class as a class asset part of investing. So choosing the right partner is very important. You have to do your own due diligence, make sure you're both aligned on the future of the company, and understand this is a long-term thing. So looking at persons who can commit to this idea or this project for the next 5 to 10 years until you are able to exit and assign someone else to be able to run your role after you're done. Don't be scared to share your idea. This is very important, especially at this stage, thinking that you have this idea and nobody else has it. I can rest assured that whatever idea you have, there are 1,000 people who have the same exact idea. The only difference are the people who execute it. So sharing ideas helps you find co-founders, helps you find people who want to work with you, help you find investors. So it's not about having a secret idea that no one has. Everyone has it. The people who are executed and try to really move forward with it are the people who succeed. And also plan for your future, know your numbers. This especially comes handy when you start saying, how much do I need to invest? Why do I need to invest? Where is the milestones that I'm trying to reach with this investment? Where is going to be spent? These are all important information that you have to prepare before going into any investment negotiations. The next stage is the seed stage. At this stage, investors have different expectations. Number one, a ready MVP. Your MVP should be already in market, already working, already having transactions, whatever it is, revenue, users, clients, whatever you are measuring as a startup. All founders should be dedicated at this stage. And again, I'll get the same questions from some people as, do I need to be dedicated at this stage, or can I do it after we raise the investment? And this is something you need to negotiate with your investor. It is common that many times that there's one co-founder already working full-time, the other ones are part-time and are willing to leave their current job once the investment is closed. Just make to mention that to your investors so that they are comfortable and understand the sacrifices you are willing to make for this startup. And then at this time, you have went from pre-seed to seed. So for sure, you have spent some of that investments. Where did that investment go? What did you do with it? How much was the return? They'll be asking about your investments into the marketing and the customer lifetime value and their cost. And all of these information need to be understood before going to investors so that you can showcase that you understand how you built your financial projections. You're asking for 5 million, 10 million, or whatever it is. Why you're asking for that is supported by what you have spent before to help defend your projections and forecasting. And then your growth plan. How are you planning to build up? What are the different revenue streams you're going to have? How much is expected to come from this? What are the base case scenarios, worst case scenarios, and best case, so that you can showcase that you have really thought through all the different parts of growing your company. At this stage, what can you expect from investors? You can expect from $1 million. Depending on your company, depending on your requirements, depending on what you really need, and how much you're willing to give out of your company. At this stage, you need to be sure to get investors who can add smart money, people who can do business introductions or share their expertise given the market or the stage you are in, because this is where many startups fail. So having that extra help in this stage is very important. So be very selective on who you share, who you let in as investors, and what they can add to you when they become part of your team. Assistance in internal restructuring. So this has to do with some investments into startups, as you might know, would require to be restructured as a offshore entity that owns the operating company in Saudi. This has to do with different regulations and clauses that are utilized for venture capital type of investments. So you will find VCs requiring you to create an offshore company in ADGM or British Islands or these different jurisdictions, because of the different requirements they have as a fund to secure their type of investment, and for the founders to also to get their rights as founders and be able to get the vesting, get the ESOP, and different parts that help these startups establish their journey as a startup. This is not always a requirement in the seed stage, as many seed stage investments raise investments through convertible notes. I have mentioned convertible notes before. These are called either SAFE or KISS notes, where you as a founder can raise money from different angel investors or even sometimes VCs, and they will give you the money. And this paper that you're signing promises them that you will give them shares on the next investment round, which is Series A or Series B, whatever it is, with a certain valuation and a certain discount if that valuation was not met. And then if in case you were in the seed stage and you applied to accelerators, you can expect from accelerators different office space, training, marketing tools, similar to the one you might received in the pre-seed. For seed stage, you have several options. One of them is angel investors, like Uqal, Riyadh Angels, Falak, Women's Sparks. These are different groups of organizations where they have created a systematic approach to angel investing. So they have members who are all angel investors. You as a startup can apply. Your application will be reviewed by these entities and make sure you are qualified enough to pitch in front of all these different angel investors. They don't participate themselves into this. They just help bridge the gap between you and the different angel investors. Then comes the accelerators. We mentioned these before. Accelerators are intense programs that are done by different entities like Techstars or 500 Stanable, MISC, who will put you between a 3 to 6 month program focused on getting your company to the next level. Next level before was from pre-seed to seed. This one from seed to maybe pre-series A, until where you are ready to pitch to investors. They add lots of value. Some of them take equity and some of them don't. You should read the different requirements of these different accelerators to understand which one is best fitting for you. Also, at this stage, there are lots of VCs that are willing to invest into seed stage. These are the logos of some of them, and I'll be sharing a link later on that will have the list of all the different parties here mentioned. Next comes the Series A. This is where things get very serious. This is where you have reached to a level where you have a bit of a product market fit. You are ready for bigger capital, and you are ready to grow in a faster space, and you want to build up a bigger team. So the requirements investors will have is much harsher. First one are detailed financials. All the information of how your money was spent, detailed, audited, even sometimes from some investors, should be there, clarified about where the money went, how it was spent. All the metrics that you have should be ready and clarified. And also the projections. The projections can't have much assumptions in it. I mean, you will of course have assumptions. I'm going to do how much in the next year and the year after, but all these assumptions are built upon previous data, the cost of acquisitions of customers, how much you're gaining from each customer. All of these are metrics that help you build up these assumptions, should be there part of the Excel sheet, so that you can strengthen the case of your forecasting information. There should be some clear growth in the clients or the suppliers, whatever you are providing as a service. So the trend is more up, not going down, so that you can go to Series A and you're confident to be able to close that investment. The use of funds, where are you going to spend it and why? Preparing the data room, which I'll share later what it is, but it is in summary just a fancy word for a folder that's very well organized, has all the information needed for investors to be able to evaluate your company and decide to invest or not. And then the corporate legal structure, as we mentioned before, many VCs, especially VCs from abroad, and even ones located here in Saudi, would require you to have a type of offshore structure for investment. So here, whether you are already ready with it or might be done through this transaction, is something you can negotiate with the investor as you do the Series A. The expectation here what you should expect from investors is between $1 to $30 million as an expectation of what a Series A would look like. But at this stage, I would really recommend you as a founder to ask what's the value add, because Series A is something many investors are interested to invest in. Why? Because you have bypassed the risk of pre-seed and seed. You have proven some growth and traction, and you can. It's a much riskier, yet you haven't reached to the maturity level where many investors want to join in. So you can start asking what you as an investor will be adding in. Are you a follow-on investor? Are you going to help me introduce me to new regions, new countries? Are you going to help me with hiring? What's the value add that you can add as an investor? As I mentioned, there are a lot of funds that like to invest here, including us, TechInvest.com. We do Series A and Series B investment rounds, and we like to invest in these, and we co-invest with many of these different funds and different transactions that we have. But also, you should look at strategic investors. This is where, due to all the changes that are happening in Saudi and the interest of the disruptions that are happening to many corporations, many of them are looking to diversify and start investing into startups that are in their industry or can help them improve their own industry. So these are some examples. If you're in logistics, Agility has shown time and time again investing into different companies like Swivel and others in the region. Bupa has created Bupa Ventures. They invest into in the medical field, in the insurance field. Ilm has to do with data, especially anything that has to do with the products. They like to look at where they can invest strategically, where these startups will help improve some of their products. Jimco, when it comes to automotive, retail, there are different people in the retail industry, زي الحكير وغيره مش الهوب. Deep tech, if you're really focusing on creating things that are very sophisticated, that you might not find many people who are willing to invest into these interesting technologies. Kaust is a great place where you can raise investments from. And these are the other different sectors and companies that are looking to invest into this. Also, a third option is family offices. In addition to them maybe owning different corporations, they are high network individuals that are looking to invest directly from their own family office into these companies. And these are a list of many of the family offices that have already shown cases of investing into local tech startups. So I'd recommend when you're in the Series A, you look at which of these offices might be the best fitting for you as a startup. Now we're going to talk at different investment options outside the VC world, which is crowdfunding. These are organizations licensed by SAMA and CMA, that allows for individuals to invest into startups or in companies. Manafع, Imkan, Scopir, Mekial, all of these are organizations where you can apply to them. They will review your company, will decide if you qualify for investment, and then help you raise that investment from their retail investors, and will take some service fees or some cut of that investment. But this is a way where you can raise money fast, but you'll be structured in a local Saudi structure, as this is one of the requirements. And maybe raising VC investments afterwards might be shown difficult, but at least you have the funding to be able to create a company. Maybe you don't need to raise additional money. And I mentioned before, one of the ways you can raise money without giving any shares. Athir is an example of a crowdfunding by rewards. Means you can have people invest in you, or not invest with you, give you money, and you promise them a certain privilege once you launch. And this is a way to help kickstart your company with funding from others. Venture debt, we mentioned this at the beginning. This is another way of raising, of getting money, which is a loan, but a risky loan. So these are organizations that are willing to loan risky startups, but they put certain clauses that protects their risk. So one of them is also especially the high rates that they might provide. They might have warrants on shares. Means in the case of you not being able to repay that loan, they might get shares into your company in a very steep discount. That's a way for them to mitigate for the risk. But they have flexible ways of getting payments. They really study your cash flow and understand what are you getting and when are you going to be profitable, or when you can repay their debt. And they structure things in different ways so that it fits your startup in the best way without hurting you as a company, because they are people who are interested in your success, but also interested in protecting their money. So they have they have to work to make sure the deal goes through in the right way. Now we'll talk a bit about how to pitch. A pitch deck is the main thing you should have prepared. This is something any investor will ask from you. It is the first thing any investor will ask from you, and it summarizes everything about your company and why they should invest. It starts by the problem. What's the problem you see in the market? How big it is? The solution, which is supposed to be yours. The market size, how big the market is. This also helps you as a founder to understand if this is a problem worth solving or not. Because if the market is very small, many investors won't want to invest into it, because the probability that you'll be able to gain all of that market size is very minimum. So a portion of that is very low and not worth the investment they will do. Also, some founders might find issues finding numbers for these market sizes, especially the data getting it from from Ministry of Commerce or different organizations are a bit difficult in Saudi. I would say there are different reports out there, but it's best to bring it from different sources and build it all together and showcase where you get the sources so that the investors understand the data sources that helps them make that decision. Then showcase your orders and sales, the traction that you have in your company. The competitors, very important. Mention everybody, direct and indirect. Where are your customers going? Don't leave anyone out. Make sure you have mentioned everyone to showcase you understand the market very well and know who's out there. And then mention the competitive advantage. Sometimes what I understand I see many founders do is they're worried about mentioning another startup, because in reality, there's not much that differentiates them. You're building a similar startup to another person. That's fine. It might be the team that makes a difference, and you focus on that part. Or it might be that the market is very huge that allows for different competitors to be there, but don't leave anyone out. Then talk about the team, about the co-founders, their previous experience, why they're best fitting for these different roles. And also, if you are in a specialized industry and none of the co-founders are specialized in that specific sector, maybe mentioning some key management that you have hired that can give you that expertise in the market. Then talk about the investments, how much you're asking for, where is it going to be spent, your future plans. What are you going to do next? What are revenue streams you're thinking about? What's the next milestone that you have in mind? This has to all be in one pitch deck that is straightforward, that is a standalone deck that you can share it at any time. And especially in the beginnings, where it's in the pre-seed and seed stage, you should prioritize the story over the numbers. Because again, you just started, you don't have numbers, you have maybe forecasts that you have. Focus on the storyline. Why is this a problem? What you might have faced, or why you think this is a big problem, and the story behind it. And then always keep it updated. You never know when an investor will come and will ask you for a pitch deck. You don't want to spend weeks improving and updating the numbers. Make sure you have it in a way that's easily updatable so that you can share it right away with the investors to move the discussions forward as fast as possible. We mentioned before a data room. These are expectations usually at Series A, but it's fine to have it at seed and also pre-seed if you are very well equipped. These are the components expected in a data room. The company documents, incorporation, cap tables, any safe notes or KISS notes you have signed, board meetings, all of them should be there in the company documents. The financials, the Excel sheet that shows the actual financials, your projections, best case, worst case scenarios. I love those when they're there. It helps me see that you have thought through all the different scenarios of your company. The marketing material. What's your strategy? How the market size? Again, how did you build up that market size? Especially if there's no one source to give you that information. IP and technology. Some VCs will ask to understand how you built your tech and what are the tech stack and the patents you might have. Sales. This maybe sometimes I don't see many founders put a priority to, but it helps close deals by showcasing to different investors that you have started talking to different customers. You are in different in the funnel of different customers discussions, or have a list of ones and contacts that you have that you are willing to do once you raise the investment or build your app. So it showcases that you are ready to go once the investment happens. And then about the staff, the resume of the co-founders, and also some key management if you felt that having those will add value to the team, showcasing that they have the right expertise to help you build the company. So now we'll get into around the final part of this presentation, which is general advice. These are things you should not do during fundraising. Number one, take rejection personally. You will receive 1,000 or more than 1,000 no's before you get your first yes to invest. So don't take it personally. Understand why they might not have were interested to invest, and see if it's appropriate to change it towards what they want or to improve the numbers until it reaches to the level that they are more relaxed to invest in. Don't lie and mislead. We are a small community of investors still. So whoever lied to one investor, that investor will definitely have mentioned it to other of their friends investors, and it's a small community. So make sure your reputation in the market stays correct. Don't lie or mislead. Don't talk too much. That's especially when you're trying to utilize the small time you have with investors. Make sure you have practiced your pitch deck, your elevator pitch, all of these things before going to any investor, so that you are clear and concise when you're discussing with them to help them understand what you are building. Don't forget to follow up with investors, especially VCs. They are on ongoing discussions with maybe 500 different startups. Although they might be interested in you, sometimes it falls out of the radar and forget to follow up with you. So make sure you take the initiative, follow up, see if this is still a hot lead or a cold lead with any of these investors to see if it's appropriate to continue discussions with them. Don't break any written or verbal agreement. This has to do with signing the term sheet, especially that, because it's a non-binding in the end. But still, it plays back to your reputation in the market. You want to showcase that if you decide to sign any term sheet with agreed terms, to just follow on with it and keep any other potential term sheets that might come at that time for the next round that might be interested. But it is fine before signing an investment, any term sheet, to discuss as many investors as you want until you have signed it. Don't be difficult to deal with. This goes back to the criteria investors use to evaluate startups. It has to do, of course, with the product and the traction that you have, but also the team. So the founder and how you manage your investment round process is very important. Being too difficult plays into character. Maybe you'll be difficult to deal with in the board, difficult to convince on certain topics that might be important to build the right startup. So this is where investors evaluate the founders. Requesting to sign an NDA, many VCs will not be interested in signing any NDAs, especially that it adds unnecessary liability to them. However, if you saw that the investors already invested into a competitor, it is fine to ask for an NDA. Request funding at a bad performance. I think this is clear. If your company is not doing well, raising from new investors looking at your company might not be the right thing to do. It's better to raise from your current investors or be able to improve or self-fund yourself until you have better numbers going to investors. Don't rush. You should have at least cash flow enough to cover your burn for at least 6 months, because the process of closing investment and having the money in your account does take a while. And you don't want to be in a position where the investors have some leverage on you to renegotiate your valuation. Don't fundraise during Eid, vacations, and other places. Again, investors are human people being two with different families. So make sure you pick your timing when investors are available so that you can have discussions and the discussions don't get cold. Don't go for investors who are asking for a large equity, more than 40% of your company, especially for startups. You need to be giving a little bit of your company in different stages. There are different references online that I can refer to, which shows what's the best formula for each stage. But giving any stage, giving up to 40% is a definitely no. Ask more than what you need. This also plays from what the previous clause, which is if you don't need 10 million, everyone wants as much money as they want to be able to raise to build a company, but it depends on your valuation. So if you ask a lot and your valuation is low, that means you're giving a lot from your company. So you have to find the right balance between how much you're asking for and your valuation, and just find the right formula that helps you grow to the next step to improve your valuation so that you can ask for additional money for the next stage. Don't get into any negotiations without a lawyer. This I've seen more than a couple of times where founders did not understand what they were signing, and they signed maybe clauses that at exit, when the company is successful and they were exiting the company, they did not get as much money as they expected due to the clauses that were in those term sheets. So make sure you have a lawyer there explaining to you all those parts. And the inability to make a decision is another part of evaluating the character of the founder. These are different valuation metrics. These are numbers that, as I mentioned before, you should have prepared as part of a negotiation with with the founders, with investors, making sure you understand your numbers. The customer acquisition cost is how much it costs you to get a customer. The lifetime value is how much you gain from each customer you have. The churn rate, if you have a system that has to do with subscription, how much people are not subscribing and leaving your system. Monthly active users, if you are a social media or a gaming startup, that you need to know how many people are actively using your platform. Monthly or recurring revenue, that means how much are you getting on a monthly basis. That's usually associated with subscription, and you want to see that number growing month over month. The burn rate, how much you spending as expenses every month, and then your growth rates year over year, quarter after quarter, so that you can also evaluate how much you're going as a company. This is just a simple case study of how any startup journey looks like. you as a founder prepare the data room for the investment and do all this numbers and understanding of your company and all the information we mentioned from before. You contact a large number of investors. You throw a wide net, discuss open as many doors as you can. Then start having multiple meetings and discussions with the ones who showed interest. Choose a lead investor. That's the person that is willing to do the due diligence on your company and provide a term sheet. This term sheet will help you later on close the remaining part of the round with other investors, but it does take a process. So the person who's your lead investor is someone who you should choose wisely, who is willing to put the time and effort to provide you that term sheet. They are not the ones who are going to raise the investment for you. They are the ones who are willing to do all that work, give you that term sheet, and are willing to invest. And you are required, if you have a big amount to invest as an investment you need, to go around to other investors, tell them, I have this term sheet from this investor. This is the work they have done. Are you willing to invest? And you can close the round. Of course, reaching to that level is negotiating through the term sheet, and you sign it, and you are able to receive the investment and do that announcement afterwards and start building your company. I'd like to start ending the session by sharing some useful references. The first one is a website I have built for different, all the logos I have shared today, from VCs to accelerators to angel investors to anything you need about the startup ecosystem in Saudi Arabia and who are the parties involved. You can find them at husseinattar.com, organized in these different ways to help you reach to these different parties. Also, I like to refer to Jawla, which focuses on the investment side of startups, explaining all the different difficult terminologies like vesting and due diligence and anti-dilution and all of these terminology that we can't go through here today, but you'll have them explained by different experts in Arabic at Jawla. Also, these different English books and Arabic books, and also some people to follow online, because it's very important to keep up to date with what's happening. And hopefully, this is, if you want to scan this, it will help you reach to the website where all of the lists I have shared before will be there. And if you follow all the examples I've shared today, hopefully you can close investment round and become one of these 800 or more than 800 tech startups in Saudi Arabia who have successfully raised investments from different parties. And that is it. Sorry, Karima, I think I went a bit over time than I mentioned, but thank you so much, and we can start Q&As. Yeah.
Not at all, not at all. Bilax, this was extremely insightful. And you should see the comments and questions coming in. Lots of people are super excited. We've got different types of people, people who are asking about how do I get investment, and people who are asking, how do I start investing as well? Where do I start investing? But before I let you answer this first question, Hussein, I must say Hussein's website is the go-to website when it comes to understanding the ecosystem in Saudi Arabia. It's definitely on my top list of referrals when anyone asks me how the Saudi entrepreneurial ecosystem looks and works and who are the players. So his website is absolutely wonderful for that. So Hussein, starting at the beginning, I'm going to come back to the questions on how to get the investment and all the questions related to that. But there were a couple of questions on what if I want to start investing? Where do I start? What do you suggest I do? And how do I become an angel? How do I grow those wings?
The easiest way is just applying to one of the angel investment groups, Uqal, Falak, and Riyadh Angels. Falak has something called Falak Angels that has also an education part of it. So they actually give you the know-how of how to invest, and then they put you part of the angel investment group where you start getting deal flow of different startups that you can invest in. Also, there's other education programs also on the website under courses where you will find different education material that helps you get into angel investing. And I would suggest to start there and then applying to the different organizations to start investing into startups.
Let's move to the other side with regards to startups.
How to raise. So how to raise is very broad. As I mentioned, I think following these steps, depending on your stages, is your key to starting. you need to be prepared. If you're prepared, these are the expectations you can have from the different investors. Make sure to contact the investors that fit your criteria. As I mean, criteria is your stage. Are you a pre-seed, seed? Who are the right parties to contact at that stage, and start applying to their pitch forms or meeting them at events. These are different ways of reaching to these investors. But that is how it's done. You have to work, talk, reach out, discuss, negotiate, and close that investment.
You mentioned, Hussein, during the talk that you shouldn't be afraid of sharing your idea with others and you should be open about it. How do I make sure that when I'm sharing my idea, this investor doesn't take it and runs with it and actually builds it? How do I do that?
So there has to be some trust when it comes to talking with investors. And I understand there are some concerns from many founders to do that. First thing, investors, especially depending on the ones you talk to, are not free to do these type of stunts of building up a company that you're trying to do. But if that's a worry that you have, you should do your own due diligence on any investor you talk to, meaning you look at who they have invested in previously, talk to those founders before, and making sure that's the right character you want to be sharing your idea with. But there's no way around it. If you're trying to sign an NDA, many of them will just avoid signing it and avoid having the meeting at all. If you think they might have a competitors, maybe that's the right time to sign an NDA.
Hussein, you also mentioned we have to be careful about how much equity we're giving away at each stage. You mentioned there are benchmarks or websites that mention that. So can you give us an indication? What is it? How much is it that you're supposed to give at each stage? Approximately what range should we be looking at?
So I have built something that helps know the benchmark. Under the website, husseinatta.com, you'll find something called the MENA reference for startups. This is a survey that I have done with more than 100 founders in MENA about how much they gave in each stage, how much they raised, how much they get as salaries for founders, how much they get salaries of their management, where they were incorporated, many of the common questions that many startups go through. And especially instead of me telling you what should be, I'm telling you what is actually in the market out there, so that you understand what is the average number there. But in summary, it's around 10 to 25%. But again, different startups, different stages, different amounts, there are so many variables to that number that I can't give you a certain number for your company that what fits your company. But I can share the information, the references there online for you to see even sector-wise what fits for you.
There's so many good questions. I'm just trying to go through them. You mentioned choosing your investors. I mean, any investor that's going to give me money is going to be a good investor. No, the more the merrier. What do you mean by choosing your investors, and what are the investors that I need to avoid, except for like them taking too much equity?
Right. Okay. This question I can divide to different parts. Yes, money is always good, and that's a great investor to have. I'd say some red flags for investors, let's say that. And you can point those red flags also on Jawla if you want to read more into that, but I'll mention some of the ones that come into my mind. Number one, if they think this is a quick way to make money. I'm going to invest in you, you're going to give me 5 times my money in 2 years. Yes? Okay, fine, I'm going to invest. That's the worst type of person, because he's going to nag on you, making sure, why didn't you reach those numbers? Why have you done? And you are going through a startup journey. You don't need that type of pressure on you, especially from people who are that type of people that might not be appropriate for you at this stage. The other ones that might want to be super involved and want to understand everything that's happening and expecting reports every week from you. These are also people who might not be the best fit for you. Again, it depends on the characters of the founders. Some of them might be okay with that. But you really want a balanced person who has some expertise, who wants to join in when you need them, who wants to add value as you require it through your process, who is willing to fund you and do business introductions for you, who are willing to fund you again if you need it. So these are the different type of investors you want to have with you as you build up your journey.
I'm going to ask you one last question because I can't keep going on with those questions. There's so many of them. But you didn't mention or touch on exit strategies. And should entrepreneurs be thinking about exit strategies at the very early stages? And should they mention it? Is it something that scares their investors? What's your thoughts on exit strategies in general?
There is no one answer, unfortunately. There are, for any startup, there's 3 exits. It's you either go IPO, and that's not an exit actually. You still have a company you have to run, and but it is a way where previous investors can exit and get some of the money in return. The other one is getting acquired by a corporation, or just building a successful company that makes money. So these are different ways. It works for different startups. Investors for different startups will have different requirements. So many companies, people build fintechs for acquisition, because many startups in that sector, in that way of business model, is usually acquired by bigger sharks. Some startups, no, you want to build something that is sustainable, that will be big, that will be provided. So there's no one answer, unfortunately, for exits. And I wouldn't tell you you have to share it or not share it with the fund, with the investors. You see what you are comfortable with and what works for your starts.
Hussein, one last question. We've seen valuation of startups in general fluctuate, especially in recent times in the rest of the world. What is your view on them here in Saudi Arabia, and do you think they've normalized, or are we going to see a decline?
So in the past 2 years, we have seen a decline in tech startups abroad. This year, we have seen it happen in Saudi Arabia. There are some startups that are raising what I would consider more reasonable valuations than what we had on 21 and 22, where valuations were crazy. Now we're seeing it more reasonable, more towards the numbers that we as investors would be more relaxed to invest in, because it will give us the return on investment that we expect, and it's a win-win situation that it should be for the ecosystem. I wouldn't say it is in a very low number. It is in a reasonable number that startups should be able to work with.
Does Tech Invest.com invest in companies outside of Saudi Arabia?
We invest into MENA companies. So anything in MENA, we're willing to look at and invest in.
Many of you asked how you can get in touch with Hussein. His contacts are right there in front of you: LinkedIn, the website, and Twitter. I know their website. I've submitted several pitches on their website. You can go in and it's super easy. There's a big red button. You press on it and you can submit any pitch that you have, and they will look at it and review it. Hussein, thank you so much for the session. This has been so insightful. And I can tell you the people that joined us today really, really enjoyed it. Please do stick around with me for a few seconds while you're to our participants. Please do stick around. We do have a couple of announcements that we want to make as usual, especially as we come closer to 24 Fintech. Hussein, feel free to stay with me as well for a couple more minutes, and as we wrap this up. Lena, can I ask you to share the screen, please?
Yes.
So, as we have been doing for the past few weeks, we do have a few more announcements when it comes to 24 Fintech. First of all, if you have not registered, it's happening very soon, and the show is going to be great. The speakers are wonderful. Zain is definitely going to be there, so it will be an opportunity to meet up with him in person if you want, or if you can, and have a quick conversation. So if you haven't registered, please do so. Scan the code and register now to reserve your spot and reserve your space at 24 Fintech. We've got speakers coming from all over the world. There are sessions that are happening on different topic, including investment. So there's more happening on investment as well if you want to learn about that and all the latest developments when it comes to the fintech space. So giving you a second here, scan the code, make sure you register for that 24 Fintech. On that topic, a lot of questions are coming with regards to the essay competition. I can assure you, we've got amazing submissions that have come through. We are going through the submissions. We are reading each one individually, and we will be getting back to you with the results very soon, inshallah. So please stick around. Application 0 to Hero, sorry, Amro, it's closed. I'm not ignoring your question, sorry, but it's closed. It's all closed, and if you have already applied, you should start hearing back from the organizers of that. During 24 Fintech Saudi will have a booth. At this booth, we will have a ongoing hourly session talking about the fintech ecosystem in Saudi Arabia. So every hour, starting 12 p.m., 12 to 1, 1 to 2, 2 to 3, 3 to 4, 4 to 5, we will have a session that runs on an hourly basis and talks about the fintech ecosystem in Saudi Arabia. This is the QR code for this session. Those sessions will accommodate for about 20-25 people per hour. So make sure you reserve your spot. It's on a first come, first served basis. Keep in mind, if you do register and you are late, we will start the session without you. And if the session fills up and you are late, I'm sorry, you will have to wait for the next hour to join us. But make sure that you scan the code and register to attend one of those hourly sessions to learn more about the fintech ecosystem in Saudi Arabia and get a better understanding of fintech in general. And it's a great opportunity to visit our booth and interact with the different people at Fintech Saudi. Last but not least, we have an open session that is happening with one of the greatest pitch coaches internationally. His name is David Beckett. And Hussein talked about pitching and the importance of pitching. Having a pitch deck is super important, but being able to deliver the message is also as important in a concise and precise way. This session is open to all. So if you are building a startup, or you want to learn how to pitch, or you want to refine your pitch, make sure you scan this QR code to attend this session tomorrow. This is happening tomorrow at 5:30. So make sure you register. It's free of charge. David is known for teaching people and coaching people on how to deliver messages in a concise and precise way, in an amazing way. So make sure you don't miss this opportunity. It's a great opportunity for you to learn more about what is a pitch deck and how you deliver a pitch deck. I'm going to give you a second to scan this. This is going to be really good. I really encourage you to scan this QR code and register for tomorrow's session as well. You will truly enjoy it. And it's a beautiful continuation to the session we had today with Hussein. All right, without further ado, sorry, you wanted to say something, Hussein? Go ahead.
No, I just have to say I have to go out now. But it was a pleasure. It was a pleasure. I hope I added value here. And it was great having you as a host, Karim.
Hussein, thank you so much. We're actually wrapping up. Thank you so much for being here with us. It was a pleasure having you. And thank you for all the insights you provided. And we look forward to seeing you at 24 Fintech.
Inshallah, I'll be there.
Thank you very much. Take care. Thank you all for attending. And we have one more session left next week. So make sure you join us next week to talk about the regulation in Saudi Arabia. So a lot of you have been talking about regulation and fintech regulation for fintechs in Saudi Arabia. Tomorrow, next week's session, inshallah, we will be covering that. So see you next week. And thank you again for joining us. And take care. Bye-bye.